Welcome to Supernova Stock Watch. We are going to discuss how to live off your dividends and the lowest amount needed if that's possible. Most people want to retire safe and sound. That's why the bulk of most people's assets go towards investments for their retirement account. But having to live off your investments once you finally retire can be as tough as saving for a comfortable retirement. Most withdrawal methods call for surprising and unpredictable combinations of investment income, interest, and selling shares, or funds, to cover the rest. The 4% rule is so popular because it takes care of this for you. The 4% rule, while simple in theory, provides a steady flow of money to the retiree without worrying too much about account balances. What if there was another way to get 4% or more from your portfolio each year without selling shares and reducing the principal? One way to enhance your retirement income is to invest in dividend-paying stocks, mutual funds, and exchange-traded funds, or ETFs. Perhaps, it can even provide all the money you need to maintain your pre-retirement lifestyle. It is possible to live off dividends if you do a little planning. Stock dividends are usually growing over time, unlike the interest from bonds. That's one for many reasons why stocks should be a part of every investor's portfolio. Furthermore, dividends have historically outpaced inflation. If you're looking for a portfolio that will allow you to live off your dividends with a long enough time frame, this may be the perfect choice. Reinvesting your dividends in more shares of stock is a smart strategy if you're saving for retirement. If they do this, they'll receive even more dividends and be able to buy even more shares. It's an investment that will pay off as the quantity of the stock they own grows. For example, assume you bought 1,000 shares of a well-traded stock that trades for $100 each. The total investment would be $100,000. The stock has a 3% dividend yield, so you received $3 per share over the past year, which is $3,000 in dividends. You then take the dividends and buy more stock, so your total investment is $103,000. Assume the stock price doesn't move much, but the company increases its dividend by 6% a year. In the second year, you will get a dividend yield of 3.18% on $103,000 for a dividend of about $3,275. However, that is a yield on cost of about 3.28%. This dividend reinvestment strategy continues to increase the yield on cost over time. After 10 years, the hypothetical portfolio from this example will produce around $7,108 in dividends. And to take it one step further, after 20 years, you would receive more than $24,289 a year in dividends. That's a great way to make money with dividends over time. But what if you are already retired? Compounding dividend income is very advantageous if you have a long time horizon. But what about if you're retiring soon? For these investors, dividend growth combined with just a little lower yield will do the trick. First, retired investors looking to live off their dividends may want to ratchet up their yield. High-yielding stocks and securities, such as master limited partnerships, REITs, and preferred shares, generally do not generate much in the way of distributions growth. On the other hand, investing in them increases your current portfolio yield. That'll go a long way toward helping to pay today's bills without selling off securities. Nonetheless, retired investors shouldn't shy away from classic dividend growth stocks like International Business Machines, IBM. These stocks will increase dividends at or above inflation and get you through the basics. By adding these types of firms to a portfolio, investors sacrifice some current yield for a larger payout down the line. While an investor with a small portfolio may have trouble living off dividends completely, the rising and steady payments still help reduce principal withdrawals. If you're looking for stocks that return dividends, it can be hard to find the right ones. Trying to get sufficient diversification too is harder than it needs to be for small-time investors. ETFs that deploy dividend strategies have been around for a while and are becoming more widespread. Dividend growth ETFs focus on stocks with a high probability of increasing their dividends. If you're looking for potential income now, high-yield ETFs are a better option. The first option is the classic option. This is looking at a company that has taken over the throne within the S&P 500 Dividend Aristocrats Index, which is IBM. IBM has an expanding product portfolio, blockchain expertise, synergies from Red Hat acquisition and solid uptake of cloud-based digital transformation solutions which are expected to favor IBM's growth prospects. Their current dividend is $6.56 per share. Not looking at future growth of either the share price or dividends, in order to make $5,000 per month today, or $60,000 per year, and living off only the dividends collected, what would it take? At the current share price of $137, and with an annual dividend payout at $6.56, you would need to purchase 9,150 shares, equaling $1,253,550 in capital, to make $60,000 a year. If that seems a little out of reach, let's look at another option. Option 2, we are looking at a high-yield ETF. The one in particular is the Global X ETF, ticker QYLD. QYLD seeks to generate income through covered call writing, which historically produces higher yields in periods of volatility. QYLD has made monthly distributions 8 years running. QYLD writes call options on the Nasdaq 100 index, saving investors the time and potential expense of doing so individually. Their last monthly dividend was 20 cents per share. Now, measuring apples with apples, we're not looking at future growth of either the share price or increase of dividend yields. We are looking to make $5,000 a month, or $60,000 per year passively with dividend investments. The current share price is $20.70. And with an annual dividend payout at $2.40 per share, you would need to purchase 25,000 shares, equaling $517,500. With option 2, you would need less than half that amount of option 1, which is more obtainable. Let's look at compound interest. We start off with an initial investment of $3,000. Invest $20 per workday, 5 days a week, equals $100 a week, which equals $400 per month. When starting out, if you were to invest your money into an S&P 500 ETF, like Vanguard ticker VOO or State Street, ticker SPY, they have an average annual return of 15 to 20%. You would have saved a total of more than $540,000 in 20 years. Now if you were to open a Roth IRA, which has an annual contribution of $6,000 per year in 2022, your $100 a week contribution would equal $5,200 for the year. Do your own research, but your retirement in 20 years, depending on your age, your monthly dividend income would be tax-free. You can always withdraw contributions from a Roth IRA with no penalty at any age. But, at age 59 and a half, you can withdraw both contributions and earnings with no penalty, provided your Roth IRA has been open for at least 5 tax years. This makes option 2 a great possibility of being able to retire within the contribution constraints. To have a tax-free retirement, being $60,000 a year would be enough. Let me know what you think about saving $20 a day towards a retirement strategy as well as leveraging high-yield ETFs. I enjoy sharing my insight with you and helping both of us become a better trader and investor and finding some level of success. You have made it to the end of my video. Thank you for watching. Please check out my other videos. Peace.